Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks. With in-depth analysis, we deep dive into financials, but we also highlight all the key risks and triggers going forward. Well, let's get straight to the first stock today. My colleague Sonal gets us a very special deep dive on AMI Organics.
Inside Out has traveled to Sachin in Gujarat to take a deep dive into the business of AMI Organics. Remember, it is a pharma intermediate company for APIs and NCEs, which is the new chemical entities, and also caters to the specialty chemicals division where they cater to agrochemicals and fine chemicals. The pharma intermediates is a bigger part of their revenues, around 84% from there, and rest comes in from specialty chemicals. They have many manufacturing facilities and exports at around 59% of their revenues. There has been a consistent growth in revenues for the company, both via inorganic and organic ways. Revenues have grown from 240 crores in FY19 to as much as 617 crores in FY23. EBITDA has seen a similar story from 40 crores to 142 crores in FY23, and profits too, from just 23 crores in FY19 to 83 crores in FY23. Now, the next trigger for the company comes in terms of strong growth in specialty chemicals and the electrolyte segments as well, where they manufacture core electrolyte for cells used in energy storage devices, and this acquisition that they made in the semiconductor business as well. The stock trades at 30 times 1 year forward earnings. So that's the valuation part of it. But to understand more about the business, let's get going and speak to the management. We have the management of AMI Organics with us. We are at their Sachin plant, and we have the co-promoters. They founded the company back in 2004. Mr. Patel and Mr. Vagatia, you are the managing director and chairman, and you are the co-promoter and whole-time director. Thank you, gentlemen, so much for joining us here on CNBC-TV18. Very interesting business, so we would definitely like our viewers to know more about it. Let me start with that. Can you tell us what is exactly the product profile here? How is it divided? What are the margins looking like? And this is the plant where everything happens.
Thank you, Sonal. Thank you, CNBC, for coming in and taking our interview over here.
Okay, so we are on the first floor of your plant, and there are so many reactors that we can see here. Explain to us about that, and also your biggest segment, pharmaceutical ingredients. What is the competition like? What are the products here? Do they all have a different margin profile? There's CDMO, there's import substitution, and what is the R&D pipeline looking like?
Thank you, Sonal. So as you say that we are sitting on the standing on the first floor of our manufacturing unit 1, plant 1, where we majorly we cater from here for the world pharma, for the regulated market as well as the generic product. We do all kind of reactions over here. Bromination, chlorination, nitration, amination. So this segment is catering market for CRAMS, regulated market for originator as well as the generic. So the margin profile for us in a CRAMS is little bit higher. In originator and regulated market is little bit lower than that, and a generic is much lower than that. But the blended margin we are always doing in EBITDA margin somewhere around 23 kind of things, which is every time we are improving ourselves so that we can able to more improving that. We are also doing some improvement in the process also, so that yield is also improved. Our customers are regularly auditing us, and we are different than the other chemical industry against us is that our standard of the manufacturing of intermediate is much higher, is equivalent to API. So you can see that we have a closed system, closed loop system, closed working. That will be different than the others.
So when you say your production standards are as close to API, so does it mean they enjoy higher margins closer to the API industry?
So the beauty of us, the company like us who had started working in this kind of segment is because there is a huge vacuum here. Either there is a API manufacturer or a general commodity manufacturer, but there is in between there is some gap which is nowadays regulations and FDA wants that chemical manufacturers should be follow as guideline as the API. So that where AMI Organics is an advantage. And this is not for the higher margin, but this is for the regulations and higher compliance, so that the customer will get the better quality material and high purity material from us.
Okay, so when you talk about margins, 23% is for the pharma segment.
Yes.
Okay, so margins are a function of a lot of things, as you said, improvement in efficiency of production and processes. The second is raw materials. How do you source them? Is it imported, domestic, and there must be a lot of raw materials?
Yeah. you are rightly says that we are buying more than 500 raw materials cumulatively, and in the 2010-11 we were around 72% importing our raw material, which is very high risk. So we decided to go our own and backward integrated, and we had done now only 18% we are importing from China. We develop the raw material and we give to the toll manufacturer to make for us. So this is how we make ourselves self-reliant in raw material. That is also one of the reasons in COVID and pandemic time we could continuously supplying our product to the customer.
Okay, all right. So from 72% imports, it has come down to 18% imports, and that has improved your margin profile as well. So how do you decide which product to enter? That is a very difficult thing. You have specialty chemicals which is smaller. You're getting into electrolyte additives also. There's pharma as well. What is the thought process that goes behind here?
Okay, so we have a business development team which is led by Dr. Ajit Chobe. He has a team which is continuously reading the medical journal for which are in the clinical trial. So we identified 17 therapeutic areas which are chronic times. So regularly these are all daily dosage forms, so give us a larger volume of the business. And they are continuously reading the new molecule which are in pipeline. So we start before other people start in generic. We start 10 years beyond the other people, so that our generic API manufacturer for the repeat market, they get the sufficient time to develop their API and then formulation. So this is how we are in the part of their DMF. And we select the molecule in a such a way that it should be fall in our 17 therapeutic area, and then we are also capable to convert that molecule into the chemistry and scaling up.
So is the idea higher margin product or higher volume product?
It is a blender of them. Our all of the products are much more higher value. None of the product is less than 1,000. So that is how we make ourselves little bit on a top line also better, as well as volume also get, so that operating leverage also we will get from that.
Okay, so that is about the pharmaceutical space. You entered the specialty chemical space with acquisition of Gujarat Organics. What is the idea with specialty chemicals? It is a smaller chunk right now.
So innovation, inception of Ami Organic was happened on chemistry. We started with the chemistry driven company. We started our application in pharma, but because chemistry has application in all sectors, pharma, agro, specialty, fine chemicals, electronic chemicals, petrochemicals. But we were growing at very normal space in specialty chemical at 5% organically. So we got a very good opportunity, Gujarat Organics, which is very fungible kind of us, having good land back, which is immediately we can expand over there. They have a multiple customer, more than 600 customers worldwide. They have also very much application in agro, petro, electronic donor kind of things. So that help us to make, immediately we can enhance our chemistry in that area. So that is why we acquired Gujarat Organics.
So are you continuing with those products, or you will be adding more products to your kitty and put in more capex?
Yeah, so it's a very good question. When we acquired, it was a top line was somewhere around 80-90 crore with the zero or negative EBITDA margin. So our first job is to make the efficient production and improve the margin. So we, in last 1.5 years, we improved the margin from 0 to 11%. But we want to also grow that segment very fast. So we introduced new segment like UV absorbers. We have introduced some polymer so we have introduced some analgesic and additives kind of things. So that is new molecules we are adding in such a way that sooner or later old product portfolio grow, which has a very high potential to grow. Parallelly, high value, high margin product also introduced in the system, which will grow, drive from the future. Currently, Gujarat Organics Jagadia plant is operating at 40%. So we have a huge upside scalability available. So we want to use that for next 3-4 years to make that company from 3-4x, which can be easily go there.
Okay, so two questions, a follow-up on this bit. Right now, specialty is 18%. When you say you'll be able to grow it 3 to 4 times, what will specialty become as a percentage of your revenue, say 3 to 4 years down the line? And what are the margins in the specialty chemicals?
Okay, so specialty, theoretically, we want to balance our every risk. So we balance our regulated generic, we balance our export and domestic. Similarly, we want to balance our specialty and pharma. So sooner or later, we want to balance between specialty and pharma like 60-40 or 70-30. And this is what we are doing right now. And margin in specialty is a little bit lower because it's a commodity kind of thing. But our target is to go to 3 or 4% lower than the pharma margin.
Okay, all right. So the next question is on this new entry that you made, electrolyte additives. You've gotten queries or orders from 6 new customers. Isn't it a high barrier entry market? You have looked at acquisitions as well for that. What is your strategy, or how big is this market first of all? Where will you stand in that overall market, and do you have any capex or acquisition plans further from here on?
Basically, the quality of electrolyte additives which are using in the battery is very high purity, and we have successfully done that. Today, the latest is 9 customers worldwide has approved us, and out of that 3 in Korea, they are contributing around 80-70% market of the world in electrolyte solution. So, and this electrolyte additive is used as one of the additive in the electrolyte solution, which it is considered an SEI, which is used as a solid. It make a polymer when you charge it. So it saves battery from decaying, as well as it is avoid the short circuit and enhance the battery life. This electrolyte volume is very high. It is marketed based on the research paper what we got from someone is around 200,000 metric ton, but we are not targeting that. Our main target for electrolyte is IRA Act, which is USA is performing, where USA wants to have a product which are not from China, and that market is also very good market, and we are targeting that market.
So I was reading a report which said the gross margins here would be 48 to 52% with EBITDA margins of 22 to 24.5%, and debt that you would require for this new facility is 350 crore rupees. Do you agree with that?
Yeah. So the new facility in Ankleshwar, which is not for the electrolyte, this is purely for the pharmaceutical. But we have our current facility in Jhagadia is capable to produce up to 500 metric tons of electrolyte additives. Beyond that, if we get an opportunity, we have that opportunity. People are right now, we are negotiating with the people for getting our price from them, because we have an advantage. They cannot use the Chinese material for IRA, and that is a monopoly for us. So we can negotiate for us about this product. So this is what we are doing. Once we reach that threshold, we can do the further capex in Jhagadia, and we can go higher volume like 5,000 metric ton to 10,000 metric ton of electrolyte.
Okay, so margins will be at these levels for that then, and revenue potential?
Revenue potential is very high. I can't tell the number of that because it's very, very high on that.
Okay, very interesting. So we'll continue that conversation on the other floor where you explain to me more about the process.
No problem. Let's go to the ground floor.
Yes. Opportunity, the semiconductor opportunity as well. Are these two high margin products? What would the margin profile be?
Okay, so electrolyte is a better margin than our pharma because it's a very niche area and there's an entry barrier there also. And the qualification system in electrolyte is a little bit difficult for everyone to get inside because they are asking very high purity material at very good quality and consistently at a large volume. In terms of semiconductor, as you saw that the numbers what we acquired, 65% EBITDA margin. But that is high margin not because of the product are going at a very large scale or something like that, but that because it's a very entry barrier business and it's a very one-on-one business is going on. We are trying to expand the business in that area as well, and that will be subsidized, normalize the margin to 55% in EBITDA level.
Interesting. So we are talking about pharma, specialty chemicals, electrolytes, semiconductor. Tell us about the Fermion deal. It was recently signed. What is it about? How big is this opportunity?
Fermion is our partner since last more than 1 decade. We are supplying lots of intermediates for them, and these are for the clinical trial as well as the commercial. There are one molecule which launched in FY21, year 21, which is a very large molecule for Fermion. And they want to do a CDMO, and they choose Ami Organics for their CDMO because they want to expand their capacity and they want to give the downstream intermediate outside. So this is opportunity got Ami Organics, which is a very important opportunity for Ami because it's a very large volume molecule, and that brings us a lot of very, very good top line in Ami Organics from FY26, 25-26.
How big that would be?
It will be very big. It is a multi-fold million euro. It's really a very huge deal. Because the final molecule, somebody has already saw the projection of that it will be $3 billion revenue for the originators.
Oh, okay. So it'll more than double your revenues by FY25.
I can't say that, but yes, we are targeting to do like that.
Okay. All right. So we got something from you on that one. But let's go to the final room after seeing these filtration machinery. Let's go there.
Thanks. So So this is the area where we do the, after reactions completion, we do the filtration over here. This is the area where we have a dedicated nudge filter dryer, which separates the liquid from the solid, and the solid is dried and then packed. So once this drying is finished, then the sample goes to the quality control lab, where they analyze and then they approve that product is ready for release. They send the report to the production department, and then they start packaging over here, and then it goes to the final quarantine, and then this go to the finished good area.
So all these products, the final products, with the capex plans that you have in place, first of all, what is your capex plan in the next 3 to 4 years? Will you be taking debt for that? And how much would that expansion contribute to top line and bottom line? What growth are you looking at?
Okay, so the capex what we had announced in our Ankleshwar unit 1, unit 2, which is somewhere around 190 crore. This is the capex for our future next 2 years demand requirement. And that will be normally our top line will be some the asset turn is around 3.5 because our product value is much higher than the value is very high, so the top line is a little bit higher on that. And that capex is sustained for up to 2026, and then we have to go for further capex in the pharma. In electrolyte segments, as I told you, that if we go with the next quarter or this quarter for the threshold of 500 metric ton, then we need capex which will be somewhere around 150 crore, maybe depends on the quantity which we are expecting to be in store. But that is the capex right now we have in our plan.
And asset turn there would be?
In there, because it's a continuous manner and it is a dedicated plant, so asset turn will be slowly will be much higher than what we have in pharma.
Okay, so maybe around 600 crores is what you'll get at Ankleshwar. Higher in electrolytes. I'm assuming with 100 to 150 crore capex that you'll do, you'll be able to get around 450, 500, 600 crores again. So that's tripling of top line from here on. What about margins with these products coming in? Margin profile would look like what?
Weighted average is currently is 23, and we are targeting every quarter improving 100% basis point in the margin side as well in pharma. So this is our quality control lab, which is having HPLC section, having gas chromatography section and analytical lab. So what happened that if the product is a solid product, we analyze here the purity in HPLC. If it is a liquid, then we analyze in gas chromatography by purity, and then other like moisture, melting point and all that happen into the analytical lab. So this is where we do the finished product analysis and then release for the final dispatch.
R&D expenditure is 1.3% of your sales right now. Do you plan to scale it up because of the new chemistries, or I would say new products that you're getting into?
Okay, 1.3% of the total top line is, I think, is a pharma industry standard, which who are not doing the new chemical entities or toxicological or CRO kind of thing. And these we want to be remain or maybe 1.5 or 2 because this is suffice for us. And last year we had developed 40 molecules.
Okay, so all the best for your plans, for all the expansions that you have in place. Thank you, Mr. Patel. Okay, with that, it's a wrap on this segment on Inside Out. Back to you in the studios.
All right, that was an interesting chat in our special deep dive into AMI Organics. Time to slip into a short break. When you're back, we'll tell you about another interesting stock, Mayur Uniquoters. That's a stock in our Swotlight segment. You don't want to miss this. Welcome back to Inside Out. Well, let's get straight to our Swotlight segment. And the stock we're focusing on today is Mayur Uniquoters. That's the largest player in the Indian synthetic leather market and one of the largest players globally as well. They are involved in the manufacturing of polyvinyl chloride synthetic, and over the next few years will be looking to ramp up its polyurethane revenues as well. Synthetic leather, well, it finds preference in comparison to natural leather as it's more environment friendly and also finds higher acceptance among ethical oriented customers, which include vegans as well. Additionally, it provides substantial cost arbitrage in comparison to natural leather. Their products find its application in automotive, footwear as well as furniture industries, and their client list includes both domestic as well as international automakers and also various footwear makers. Well, hence the company is touted as a proxy play to the rising discretionary spends towards fast-moving consumer items. Now, their revenues are mostly from the domestic market, with exports contributing around 30% of revenues, and bulk of the export revenues comes in from auto OEMs. On the domestic front, The auto revenues is accounted for via OEM and replacement sales, while the footwear segment contributes close to around 25% of their business. In the last few years, the street has been waiting for growth to ramp up, and the management's guidance has been a little bit sketchy. But now they are indicating they are in for a good phase of growth over the next 2 years, with the auto export growth expected at a faster clip. They have indicated ramping up revenue from big international automakers like Mercedes, BMW, and they have also added Ford Motors to their list of clients. The domestic auto segment as well is expected to see double-digit growth, while the footwear segment, it's been reeling under some pressure, but the management is optimistic about mid-single-digit growth. Overall, by 2025, revenue should surpass around 1,000 crores, and they have margin levers in place as well. That could include ramp-up of the margin-accretive exports, benefit of operating leverage, and lower PVC prices. Additionally, they have a clean balance sheet with cash of around 170 crores and also returned part of it to shareholders via regular dividend payouts, and have also done a couple of buybacks in the last 3 years. Now, valuation-wise, the stock trades at around 20 times trailing EPS, but factoring in the management can achieve that 1,000 crore revenue target, then it's relatively more attractive on a forward earnings basis. Moving to the shareholding pattern then, its promoter entity holds roughly around 59% stake in the company, and around 9% is held by some large funds. Now, risk, there are a few. They include what if the global slowdown derails their growth plans, which in turn will impact profitability, as exports are the driving factor out there. And also we understand that all is well between the promoter father-son duo, but in case re-emergence of friction between them, that could be an overhang for its shareholders as well. The India PU market, well, that's currently dominated by Chinese imports and presents a big opportunity. But as of now, revenues from that segment have clocked just around 25 crores. That's a far cry away from its capacity. Well, we've run out of time on this edition of Inside Out. It's goodbye from Sonal and myself. But you do write to us and tell us about companies you want us to discuss, and we'll try to feature some of them on our show. Thanks so much for watching.